Hello and welcome to this video module on basic financial modeling, part 2 of 3. In this module, we're going to spend most of our time in Excel creating a financial model, but just wanted to show the 10 steps that we're going to use again. This module will cover steps 1 through 5, with step 1 focusing on forecasting income statement items, step 2 on forecasting balance sheet items, step 3 on some very minor forecasting on the cash flow statement, and steps 4 and 5 linking a few items between two statements, the PP&E from the cash flow to the balance sheet and the depreciation between the income statement and the balance sheet. Let's flip over to Excel and get started. First sheet that you're going to open in your file will be the Assumptions tab, and if you just look down below, we've got Assumptions, we have an income statement, balance sheet, a cash flow statement, and a debt schedule set up. The Assumptions tab is just a good place for us to keep many of our assumptions grouped together, and we can see we have a company name and a label, a couple of key assumptions such as a minimum cash balance, days receivable, which will be useful on balance sheet forecasting, inventory turns, again on the balance sheet, CapEx or PP&E additions as a percent of sales, days payable, another balance sheet forecasting item, shares outstanding, which we won't use in this module, a tax rate, years of depreciation, and then our income statement assumptions, which for this module, let's just focus on the white cells here, the sales growth, the cost of goods as a percent of sales, and SG&A as a percent of sales. In future modules, we're going to learn how to toggle between cases so we can have some other options. We also have some debt assumptions down below, interest rates, amortization years for a loan, a starting amount and a starting year for a loan, and interest rates on other items in the capital structure. Let's get started with step 1 and move over to the income statement. We're going to focus on the green highlighted cells throughout much of this module, and you can see that we're going to forecast the income statement, and we have 3 years of historicals to look at. And as this is a fictional company, I had made up some historicals, and you can see in these formulas that you got 25% growth historically. And if you just flip back to the assumptions, you can see that we're going to use a little more conservative 20% growth going forward. So we're just going to put in a formula equaling the cell before times 1 plus the growth rate, and we're going to lock that cell so we can just copy it across. Boom. 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 All right, we've got our forecasted revenue. And again, a lot more thought would go into this in the real world. You'd be talking to management about what their sales expectations would be going forward, or you'd be doing a lot more research. But for the case of this model, just wanted to show you how we can set up some assumptions and use those to project going forward. Similarly, we're going to do the same for cost of goods. And you can see the formula in the past has just been 50% of revenue. So let's use that again. Revenue times 50%. And again, we're going to lock that assumption in there, and we can copy it across. 50% being spent on cost of goods means we're left with a 50% gross margin. Let's put in the SG&A line now. And that also is a function of revenue. So we're going to multiply that by 25% and lock that cell so we can copy it across. And now we've down to our EBITDA line. So we've completed step 1 of our modeling process. You can see we now have a 25% EBITDA margin, exactly in line with the historical levels. That, probably not completely accurate way to forecast, but this is just a simple way for us to do it. Let's move on to step 2 and focus on some balance sheet items. For now, let's leave cash, let's ignore the cash line, but we can forecast accounts receivable, inventory, and accounts payable. So accounts receivable is often forecasted as a function of revenue, and then it's basically how many days it takes to collect your revenue. So we're going to say it is some assumption of ours, 30 days receivable, and we'll lock that, divided by 365 days. You're basically saying it takes us a month. At any one time, we probably have a month of sales receivable, and we'll copy that across. Inventory. Inventory is often forecast as a function of cost of goods. Important to note, when an item is sold, it comes out of inventory. It comes out at the value of cost of goods, not out of a value of sales. So we're going to forecast inventory as a function of cost of goods and simply divide it by our inventory turns, which we're assuming is 4. 4 inventory turns means a company always has about 3 months of inventory on hand. And we're going to lock that assumption as well. And we could just do a little reality check if we'd like, which would be to take our cost of goods of 375, divide it by 4, and you can see that we do have that 93.8, just a bit of a reality check. Let's skip PP&E and depreciation. And you can see there's some other lines on here where they're minor balance sheet items. We're just keeping those constant, other assets. But payables, likewise, is formulated based on cost of goods as well. And the formula looks a lot like that of accounts receivable, but using cost of goods rather than revenue. So we're going to say it is a function of cost of goods times a days payable, which we'll lock, divided by the full year of days. So basically saying at any one time we probably owe our vendors a month's worth of their invoices, and we'll copy that one across as well. And for now we're going to leave debt items blank, and you can see right away our balance sheet does not balance, but hopefully at the end of these 2 modules it will. Let's move on to cash flow. Cash flow statement that you've got comes loaded with a lot of links already, so you can see that the beginning cash balance is simply the prior year's ending cash balance. Net income is coming from the bottom of the income statement. Again, these numbers aren't yet valid because we haven't completed the income statement. Depreciation and amortization, again, linked to the income statement, but we haven't yet put those items in. The biggest set of formula here on the cash flow statement is these changes in working capital. So changes in accounts receivable, changing in inventory, changes in payables, and it's important to get the signs of those right. You can see we have a negative 9.6 for the change in receivables. If we go back to our balance sheet, we can see receivables are rising, meaning that we're actually not collecting some money on sales that we made. That's why we have a negative cash flow. Similarly, payables, as payables rise, it's treated as a cash inflow. We've received services from our vendors, but we haven't paid for them. The only formula we're going to do right now is this PP&E one, and it's important to get the sign correct. So we're saying that the company is investing a fixed percentage of its revenue every year in improvements or property, plant, and equipment. So we're going to take our revenue for the year and multiply it by our assumed PP&E percentage, which I'm going to lock. And looks like I already got that sign wrong. So let's go in and say that we need that to be a negative, because a cash outlay would be a negative item on the cash flow statement. All right, we've just done our first 3 steps. Now we just need to link a few items related to these on a couple of the other statements. So our balance sheet, we now know that we can update our PP&E because it's going to be the prior year's PP&E plus, which is really going to be a minus a negative PP&E. So our PP&E is growing on the balance sheet. I'm also right now going to do a link for the depreciation, even though we don't have a value, but this is part of step 4 from our 10-step process. So our accumulated depreciation will be the prior year's depreciation plus new depreciation from the income statement, which we're about to put in. Let me copy that across. And then let's go to step 5, which is just doing the depreciation calculation on the income statement. We're going to depreciate the fixed assets over an assumed number of years or assumed time period, which for this case we're assuming is a very straightforward, just 5 years. So the formula is going to be the prior year's net PP&E plus the PP&E added during the year, which again we have to use a negative for a negative number. So that's the total PP&E that's going to be amortized or depreciated this certain year, and divide that just by our assumed years, which I just have a little menu for us, but we're going to link that to the cell that gives us 5 years, and we're going to lock that cell. All right, so we have depreciation of 15, and we'll copy that out, and we should be able to see now that we have increase in depreciation. The balance sheet depreciation should be going up as it is, and the PP&E is going up. That completes the first 5 steps. Join us in the next module when we'll get into the debt and interest schedules and finishing out the model.